Welcome to Get Serious. I wanted to comment a bit more on the overall market today and, some associated technical updates as well here. So I know I've mentioned recently on some podcasts that, I think the only deals that we're truly finding the good numbers on again are just more of the distressed sellers coming down the pike here. And that won't always be the case, especially if you're trying to do minor subdivisions and might still be able to find things closer to on-market value or otherwise here. But to really find those 2x margin plays, it really has come back to the kind of meat and potatoes of what land investing had been for so many years of just, family situations and various financial troubles that folks may be dealing with here. And that's pretty much the only archetype that we're able to find. I mean, there might still be a handful of folks, I had plans with the land and just not moving back to the area. It's like not really distressed from that sense. We still see that sometimes, but it's been just a bit more rare comparatively. And so I just wanted to run down even some other items to break down more on the macro level here. And I follow Scott Galloway. Many of you might have heard of him. NYU professor, has done really well in various business ventures, a pretty well-known author. And within his newsletter earlier today was just remarking how there was kind of some conflicting notes about the market, because I saw a report last week too, where it's like, okay, Q2, GDP was 3.8%, fastest growth in almost 2 years. Corporate earnings are on track to rise another 12%. Third straight quarter of double-digit growth. Retail sales rising last month. Stock indexes highest ever, within the last week or something. And this is as of late September 2025. But so much of that is driven by just these booming AI stocks for the most part. Like even if you try to diversify away from that, and there's these other stats too, I won't belabor the point, but you pretty much can't avoid it, whether you're in, even if you're in public REITs or overall indices, you have such huge exposure to really the top 10 US stocks and those huge, at least oriented companies, that's really, what's driving most of the returns within the overall market here. And so it's kind of just overweighting how healthy the economy is, whereas most folks are just not seeing those actual returns or getting kind of a share of those earnings and profits there. Because again, the key stat to go back to is that, the top 10% of the US drives 50% of all consumer spending. And I forget the note about, breaking that down even further, but I want to say the top 1% is responsible for close to a third of all spending. So it's even more weighted in between that. But when you kind of keep that in mind, and actually to pause there, a couple other tangents on why, the lower 90% is probably just continuing to struggle a lot. And there were some really good stats about how cheap food items, the purchases and searches for those and sales overall have increased year over year by a significant margin. People are searching kind of for cheap eats. More folks are looking for help with their mortgages. I commented last week too, FHA delinquencies for mortgages, 40% of all delinquencies now, and they're at sorry, I'm mixing a number of the numbers. Some of the stats together, but I know I commented, I want to say last week that, the FHA mortgages or the delinquencies are as high, if not higher than they were during GFC. And FHAs tend to be more lower income or first time home buyers. So they can be more of a leading indicator for those more at financial risk anyway. It's we are seeing more of that distress here. Or how about this one? 1/3 of all adults in the past year said they've opted out of getting healthcare they needed because of the cost. And I know as an entrepreneur too, that's one of their biggest expenses, like pretty terrible health insurance overall, and just paying like close to $1,000 a month roughly for stuff that has like huge copays all the time. So like I'll defer on paying anything too. Or I like the cardboard box making capacity. I know that's like a key trigger. They're saying it's down 9% in just 8 months. So that's double the cut seen in the GFC. And generally these cardboard box metrics are related to, okay, are people, just buying extra consumable supplies, or, various gifts sometimes can be related to like, are people moving? So generally it has to, like, cardboard boxes are a good just overall indicator of economic activity. And the fact that they're down pretty considerably is just, again, kind of a leading indicator of lower sales. More pets ending up in shelters. And this is the last data point. I just think this is so fascinating. There was a recent estimate about the cost of the American dream, which is a wedding, a home, kids, college, etc. So I don't know like the exact numbers between that, but let's say like maybe a median price home, a couple of kids, and college educations, and that's coming out to like more than $5 million over needed to earn the American dream. Whereas the stat for an average American making $2.8 million over the course of their career if they have a bachelor's degree. And so you would need at least two folks in a household earning that equivalent to even hit that American dream. And interestingly, and I found this just mind-boggling, is that having two parents, whatever, or two adults in a household, both with a bachelor's degree and working, only represents 7% of all US households. Like that, it's just crazy. I thought the education rate was like way, way higher than that. It just kind of blows my mind. Or maybe they're not including like renters or something too within that. But that just seems like an absolutely alarming number. But the ultimate piece of this is that, we're overestimating the ability oftentimes of what the average consumer can actually pursue, and just, again, how much consumer spending is just related to that upper echelon of earners in the US here. And so to bring this back to land, that's what I often think about. It's like, again, land is, it's a luxury purchase here. And so, again, we have to assume that pretty much every purchase, other than maybe some owner finance plays for desert squares or things like, I don't know, below 10, 15 grand. And even then, like a cash purchase, probably most folks can't make that. Like, you just have to assume you're targeting the top 10% of U.S. households when it comes to purchasing our products. So like, really, we're just trying to split, it's still a decent number of people, like over 30 million, between 30 and 35 million people who can more reliably purchase properties around the U.S., but like it's only a small sliver of the overall pie, right? So like, we just have to keep that in mind with the price points that we're working at, and that land is pretty much always just a want and not a need for people. It's a need when eventually need a place to live, but generally if you're more on the bottom tier of earners, like, you're going to be looking to rent anyway, and so you're kind of like a step removed from actual purchase of the underlying real estate. And so just kind of keeping that in mind. And so the last point I wanted to make here to wrap up this on, again, so I just think about this stuff constantly, right? Operating in a more difficult market. And there were a handful of companies I spoke to recently, bigger land investors. They were like looking to bring on like even like a VP of sales type position, like higher powered sales team. And I just wonder how useful that is within the land space, because it's not crazy hard to exhaust most reliable channels for dispoing land. I mean, first off, if you're working with a solid realtor, like, you're going to get exposure to most of the channels that are going to bring in routine buyers. This is something I remind myself often too. And like when you look at like real estate purchases, I want to say like 80+ % of them happen from the MLS. So like you're hitting the lion's share right there. Of course, yeah. How can you maximize that remainder 20%? But just listing it is like most you're going to get the most eyeballs. And sure, you can have like the land.coms, etc. But even then, okay, that's another avenue you can look at. We know, yeah, you can potentially cold call, text, and letters to folks in the area. There might be some other, bulletin boards, hanging up signs, etc. But pretty soon you start to exhaust your potential buyer pool without really running into significant just cost or time of your team. Like if you're trying to reach, like out of all those avenues that I just mentioned, if you're trying to reach anybody more, because like I think about this stuff all the time, right? Like what else can I do to bring buyers to the mix, especially for struggling properties? And you really have to start to reach. Then it's like, okay, how much more money would I be willing to throw to, like, I don't know, market to every single person in the township? Or maybe you could break that down into certain slivers of more active buyer profiles, or everybody in the county, depending on, the total population. But like that gets expensive really quickly, whether you're trying to do cold calls, texts, or letters, especially letters. That's going to be like crazy expensive. But yeah, from a timing side too, like, if you already have a cold call or text team, especially for acquisitions, then you basically have to build in, maybe double the cost now just to try to handle extra dispo side for what I think is just on average reaching more for less qualified buyers and less interested in general, especially when we're in like a pretty deep buyer's market in most parts of the country. So like I just kind of wonder, how aggressive can you really be in sales in this space? Yeah, you could consider doing paid ads potentially too, or kind of really solid SEO work, PPC possibly. Again, you can kind of like manipulate channels that work for acquisition but use it for dispo instead. But again, it's going to be like super targeted. Even if you have a huge brand presence, it doesn't help you that well when you're looking for such like a highly targeted local buyer for the most part here. So like, I mean, you can correct me if I'm wrong here. I'm open to comments if you have any thoughts, but I really question the validity of like a high powered expense, potentially probably expensive sales team to really try to push properties. Like again, kind of a luxury good here. Like same thing, okay, maybe like, okay, consider like Burberry or Louis Vuitton or something like that. Yeah, they can kind of exhaust their sales channels, but like if people aren't coming into the stores or they're not going on the websites and they're kind of like pushing out it. I know it's a little bit different here because it's also like a mailable good for the most part. So you get like exposure to a larger client pool. Plus again, even those expensive luxury goods like usually aren't as pricey. Like maybe it's a $5,000 suit or even 10,000 or something, but that's still like on the way cheaper side of land here. Like so it's still like a different level of purchase for the most part. But like you don't see like door to door Burberry salespeople or anything, or trying to do like I've never gotten a mailer from Burberry or a cold call. Hey, like when you want to come in and buy like a nice coat or something. Like it just they kind of have to meet these luxury buyers where they're at. Maybe I'm misunderstanding something about their model. They've clearly built crazy good businesses, but I kind of think of land in a similar setup here. It's like it's going to get so difficult and expensive, and I think super inefficient to like over push dispo. Like if things are slow, like they're just slow, and you just have to figure, and you have to be just willing to be patient and wait longer if you're exhausting all the other channels. So if I'm missing anything, you can let me know. Again, we think we're pretty on top of the dispo side, and I've talked to a lot of folks I think are kind of the best in the business, and like we've kind of just tried everything that I'm aware of at the moment for most of these properties, without again like trying to mail or call like every single person in a township and County, which is just, to me, it's an option on the table, but I don't think it's realistic and even remotely cost effective to pursue for virtually any property out there. So just something to keep in mind. Let me know, seriousland.capital, for any of your funding needs, 50K purchase price minimum, Land Daily Diligence Facebook group, and landpricer.ai. We're just burning through the UI UX improvements here. So most reliable land pricing tool on the market. Check out Callan's Bootcamp. Again, that starts this Thursday, October 2nd. If you haven't signed up, it's only $97. Get it while you can. With that, subscribe and share, everybody. Take care. Bye.